Hello everybody, and welcome to the performance report for the third quarter of 2016. So we had some very exciting market moving events this last 3 months, and we also had some great results going through that. So I want to talk about those in a few minutes. But first of all, I just want to really quickly apologize if I look or if I sound like I'm drunk. I assure you that I'm not, but what happened was I herniated a disc in my back, and it's caused some pretty major nerve damage to my spine and my shoulder. So I started out taking things like Robaxacet and Aleve, Motrin, Advil, whatever I could get my hands on. And I was taking about 25 a day, and it wasn't doing anything for me. It was just making me sick. But unfortunately, as a non-resident of Canada with no health insurance, it was actually pretty difficult to get some help. They wanted to charge me $1,200 just for a doctor visit. But I finally did reinstate my health insurance, and I got some good stuff. So this is the Tylenol 3, and I really like these. I've been eating these like M&Ms. This little one here is diazepam, basically Valium. Another really good one. If you ever want to spend a few hours on the couch just drooling and not being able to speak, this is the one for you. And this last one here, this is the oxycodone. That's the real deal. If I take a couple of those, I'm basically out for the count. So I've doubled up on all my dosages. Feeling pretty good, feeling loose, not much pain right now. So hopefully I can get through this video without slurring my speech too much. And we can talk about what we need to talk about. So the general format is I'm going to go through the results, first of all, for the tactical volatility, and then the tactical balance strategy. We'll talk about a few of the things that happened during the last 3 months. And then towards the end, I'm going to actually answer some of the member questions. And I do get asked a lot of questions, and I encourage everybody out there to ask as much as you want. I love answering them, and I'm a workaholic, so you're never going to have to wait very long for an answer. You know, I'm working all day and all night, basically. So ask me anything you want, and I'll answer them. A few of these questions reoccur. You know, more than one person has asked them, sometimes several people. So I wanted to answer them in the video. And stick around till the end, because one of them you're not going to want to miss. One question that I get asked quite often is to compare my results with some of my competitors. They will email me and say, hey, I noticed that this guy made such and such percentage and you only made this, or, you know, this guy's doing that and you're in something else. So, you know, I'm not trying to call anybody out, and I'm trying to be as objective as I can. But towards the end of the video, I am going to be opening up some websites of my competitors and actually going through their results, comparing them to my own. So you're not going to want to miss that one. So hopefully I didn't overdose on all of these pills. Hopefully I've got a good 20-30 minutes before things really start to fall off a cliff. So let's get started. I'm going to open my computer, and we're going to get into those results. Okay, so since I do have the policy of not making excuses for myself when I take trading losses, because they do happen and nobody likes to hear excuses, on the flip side, I also don't like to brag too much when we do really well, because that's equally annoying. So I'm just going to report the numbers as they come in, and I'm going to use the website to do that. So let's go through the tactical volatility strategy. By the way, you don't have to wait till the end of the quarter to see these results. I keep the website updated quite regularly. But the quarter that we're talking about is July, August, September. So it's these 3 months right here. And we made about 60% this last quarter, which was good because, as you recall, in June, we did have that drawdown. We had that one day in particular that sort of came out of nowhere. The volatility market didn't really relay that signal early enough, and we got caught on that one day. So it's nice to see that we recovered. But results aside, I always think what's more important is avoiding the bad trades. I mean, to be honest, making money trading the XIV isn't that difficult to do. Sometimes if the markets, you know, if they're creeping upwards and the VIX futures term structure is in contango for an extended period of time, the XIV itself is going to make a ton of money. So making profit is the easy part. Avoiding losses is really what it's all about. So in the blog section, I sent this out to the newsletter subscribers recently, and I always update this. You see this article called XIV crashes of 10% or more. The XIV has actually crashed over 10% 32 times in the last 6 years since the product launched. And 2 of them happened this quarter. So you can see here's the September one, down 15.97 in a single day, and this one down 12.81 in a single day. So a couple of big down days, and of course we were in cash during both of them. So that's basically the strength of the strategy. Again, I don't care about chasing big returns. The returns take care of themselves. I spend 100% of my focus on risk management and avoiding the bad trades. And the way that we do this, obviously, is scrutinizing the signals. I collect data from about 10 different sources, and I rank them. And I'm only in the trade if all of them agree with each other. So I'm going to open up my spreadsheet here, my super secret spreadsheet that I don't show anybody. This is the end of the quarter, end of September. And I'm just going to scroll over to the strategy and show you how inactive this strategy actually is. So here's the VXX. This is the inverse. We really don't trade this one very often. Only when things really go off the rails will we be in this one. And as you can see, 1.98% we were in the trade. So only 2% of the time we were taking trades. Of course, if there's a financial crisis, we're going to be in this one a little bit more often. I'm not saying I'm hoping for a crisis, but I'm certainly prepared if there is one. So this will be more active if stocks take a nosedive. The XIV is, of course, more active, and that's where most of the profit is coming from. Again, though, only in 45% of the trades. So over half the time, my strategy is in cash. That's the strength of the strategy, is that we're ranking these signals. We're only taking 45% of the trades, and the rest we're just leaving on the table. And that's how we were able to avoid 29 of the 32 biggest drawdowns in these single days. So again, it's not about making profit. That's easy. Basically, the XIV goes through extended periods of time where it makes a lot of money. What you really want to do is avoid those drawdowns. So if you go through the monthly numbers, you'll see that we're quite successful at that. Unfortunately, I had a few subscribers leave. Subscribers. That's a hard word to say when you're doped up on all these drugs. I had a few subscribers leave after this drawdown, unfortunately. And, that's obviously people have to make their own decisions. But if you have a good strategy, you really don't want to leave after a drawdown if the strategy has shown the ability to bounce back quickly. So if you go back to all of these results, here's a drawdown here. There was a quick bounce back. Another 3 months in a row, that wouldn't have been very much fun for subscribers, but again, recovered fully the next month. Here's a big drawdown, actually the biggest one, and it was recovered very quickly. And since in the last 3 years, I've had very, very few drawdowns. It's been a pretty good run, but there's another drawdown again this year. That one day in June, it just kind of came out of nowhere, but we recovered it quickly. So the bounce back of this strategy is happening because we are scrutinizing those signals. And I'm only taking 45% of the market. So drawdowns tend to be very small. They tend to be very short-lived. And we do tend to bounce back from them. So that's the volatility strategy. Just real quick, here's the chart. We're off to new highs, so everything's looking good. Okay, so now let's look at the tactical balance strategy, which remember, this is trading stocks, bonds, and gold. So it's entirely different from the first one. Now, this one, there isn't a whole lot to say, of course, because we basically held stocks for the past 3 months. There was a couple of days there where we got into some bond trades, but for the most part, we were just tracking the stock market. So here's the S&P 500 for this year. You can see this hash mark is January, and actually the first week of this year was the worst start to a calendar year on record for the stock market. So it was pretty ugly early on, and this is when we were trading gold and bonds, and we made a really nice profit during those few months. But you can see in the last 6 months, there's been really no reason not to be in the stock market. All of our signals are just saying maintain stocks. They're not really going up a whole lot, but again, there's no other asset class to really be in right now. So again, I can show you my spreadsheet, and I'll do it quickly so people can't see what's going on here. It's very secretive. But here's the MDY. This is the stock portion of the strategy. We've been in 50% of the trades in the last 6 years. And that's what we're basically targeting, is we want to take half of the stock market and we want to leave the rest because, of course, we're not buy and hold investors. Buy and hold is a dead strategy. It's been dead for decades, but apparently the financial industry has not given it its eulogy yet because they're still using it for some reason. But buy and hold doesn't work because you're going to be riding out those excruciating drawdowns. And that's what we're trying to avoid. This is a tactical strategy. So we're in 50% of the stock market. We are in, this is IEF bonds. We're in 25% of the bond market. And gold, when things are really looking like they're going to go off the rails, this is when we trade gold. And again, a quarter of the time we're in gold. So that's why the strategy is tactical. And that's why it works. If you look at these results don't look the same as the stock market. Remember, the stock market didn't even really break even until mid-year. But because we were trading bonds and gold early on, we were actually able to make a nice profit when the stocks are going down. So, not a whole lot to say, actually. It was a very boring quarter for the tactical balance strategy. So now we can put those two strategies together into what I call the total portfolio solution. So this isn't a strategy. It's basically just 25% of the volatility strategy and 75% of the tactical balance strategy, and you put them together. So the reason that we do this is, of course, for diversification and long-term stability of the fund, right? So I'm not young. As you saw in the opening part of the video, my hair is turning gray. It's starting to get a little thin on the top. I'm not young, but I'm young-ish. I'm 42. I have a multi-decade long time horizon here. So I'm not a short-term trader. I'm a long-term investor. So I can't tell people what to do with their money. Of course, your investment decisions are entirely yours. I can just tell you what I'm doing with mine. And making 60% a year or, in a quarter, like the volatility strategy, that's a lot of fun. But I do like the diversification of both strategies together because you get results that look even smoother. And this is really my end goal. I'm not trying to build strategies for people to, excuse me. I'm not trying to build strategies so that people can put a little bit of their play money or their, what they would call their risky asset money in and see what happens. I'm trying to build strategies for people that they can feel comfortable putting a significant portion of their retirement fund into, and so we can grow these over the next 10 or 20 or 30 years. And the only way to do that is to reduce the drawdowns to the least possible amount, to increase the diversification so everything is safe, and to give people a smooth, consistent curve. So that's what the total portfolio solution is. And I would encourage people to consider, if you're going to be subscribing to my strategies, and of course, do your due diligence. I'm going to be going over some of my competitors later on, but do your due diligence. If you do subscribe, I would encourage people to do what I do, which is diversify into both of the strategies. And it's not like you're losing a lot. We're still up 35% in the diversified portfolio. And again, for those 2 subscribers that I did lose in June, what I told them then and what I will say now is a 20% drawdown, yes, that is hard to take emotionally. There's some emotional capital that was spent there. And apparently it reached a limit and they couldn't take it and they left. But if you were trading the total portfolio solution, it's only a 4.6% drawdown. And you're not giving up a whole lot because we're still up 35, almost 36% this year. So just consider the advantages of diversification. Again, our long-term annualized returns, we're not losing a whole lot by diversifying. But what we are gaining is a Sharpe ratio and an Ulcer index that is extremely high. These are risk-adjusted measures of return. So very safe. And this is what I would encourage people to do. This is the portfolio that I'm following. I'm also an option and derivatives trader, so I do have other strategies that I employ. But as far as my ETF strategies, I much prefer this as opposed to just one or the other. I like to do both of them. So that's the total portfolio solution, and those are the results for this quarter. So now what I want to do is actually get into the question period, because I think there's going to be, certainly that last question is going to be an interesting one. Okay, so now I want to get into the 3 questions, and the first question involves trading within tax-sheltered accounts. So if you're an American, it's called an IRA. If you're from another country, it might be called something different. But essentially, for the most part, these IRA accounts and these tax-sheltered accounts don't allow you to trade on margin. So some of them are labeled cash accounts. Now, the problem with that is that there's also something called a T+3 settlement law, where you actually have to wait 3 days before the money becomes available again to make a purchase once you've previously sold something. Now, my strategy isn't very active. It only trades 3 times per month, but there are times occasionally when we take quick trades, sometimes even one-day trades. Now, this would pose a problem in a tax-sheltered account that has a T+3 settlement law. So the question becomes, is my strategy still viable within these accounts? And the short answer is yes, of course, but I'm gonna demonstrate why that is. So here's a chart that I made showing the original strategy in green, just as it is on the website. And then I redid all the numbers going back to the beginning to show what the difference would be if you actually followed the T+3 settlement rules. Now, as you can see, it's quite similar. It tracks very closely. The annualized returns for my strategy is 84%. That's the green line. And the annualized returns for the T+3 strategy are 81. So there is a loss of 3% there, which really, in the grand scheme of things, is no big deal. But on the flip side, it was a little bit smoother. So the Sharpe ratio was actually a little bit higher, only because just random luck. The markets are basically just a random walk on a short term anyway. But you can see in 2015, skipping some of those one-day trades that did actually increase the drawdowns for my strategy, it would have been better off to hold. So basically the result is it's more or less the same. So if you are trading within a margin, a non-margin cash IRA account, all you would have to do is every time that we make a sale, you're just going to have to wait 3 days regardless of what the signals say, and then pick up the signals on that day 4. Doesn't really make any difference in the long run. You know, you're going to win some, you're going to lose some, and in the long run, it's going to be almost exactly the same. Now, having said that, these days there are a lot of available margin IRA accounts and margin tax-sheltered accounts that essentially allow you to trade as if it's a fully margined account. Now, it won't let you trade more than the value of the account. You still can't trade technically on margin. You could, if you have $100,000 in there, it doesn't allow you to buy $101,000 of any product. But, you know, it does avoid the T+3 settlement rules, and you can trade your IRA account or your RRSP if you're a Canadian exactly as the strategy would go. All you have to do is go shop around for a margin IRA account, and there's a lot of them available. Interactive Brokers has one, TD Ameritrade has one. I'm sure many brokers these days have them. So all you have to do is get into a margin tax-sheltered account, and then it eliminates the whole thing. But of course, if you didn't want to do that and you just wanted to keep your money where it is, like I said, you just take the signals. Every time we make a sale, just wait 3 days in cash, and then pick up the signals on day 4. Okay, so another question that I get asked quite often has to do with the tactical balance strategy. Now recall, in the tactical balance, we're trading stocks, bonds, and gold. And when we think of the stock market specifically, we usually think of the S&P 500, and it's the SPY, the SPY, that's the ETF that tracks the S&P 500. So the question is, why do I trade this thing called the MDY? Now, the only difference is the MDY is a mid-cap fund rather than the broad fund for the S&P 500. And over time, they perform more or less the same. It's just that the MDY does move a little bit more. So when markets are going up or markets are going down, it does tend to move a little bit more. The long-term results are fairly similar, to be honest. But the reason that I trade the MDY, I guess the short answer is because I'm a workaholic and I've crunched all the numbers for all the various tickers and indexes that I could possibly be using. And it's actually the MDY that's the most advantageous. So here's a chart that illustrates that. This is the same strategy, crunched through the same signals and the same indicators over time. And as you can see, the MDY has outperformed the SPY significantly. This is not a small amount. This is over a 10-year period. It is a substantial difference. And the reason this is happening is because for my balance strategy, remember, I'm ranking all of my signals and indicators, and I'm only taking the top 50% of the market when it's the most advantageous to be trading stocks. The most obvious times when the stock market is the best asset class to be in. The time that you wouldn't want to be trading the MDY, you'd rather be trading the SPY, is on the other side of that equation, when maybe the stock market is going down and the signals have degraded to a point where there's some significant risk there. But my strategy at that point will be trading gold and bonds anyway, so it doesn't matter. What I'm really focusing on for the stock portion is the highest quality signals. So I do want something that moves a little bit more. Now, I can't use the small caps. It would be the same thing. It would move more, and it would also outperform the SPY substantially. But with the small caps, you run into problems with liquidity and, stuff like that. And you want something that has high liquidity and also more stability. So it is actually the MDY that is the most advantageous to my strategy. Okay, so for question 3, the one that I alluded to, which I get asked all the time, this is probably the most common question that I get asked, is to compare my results to my competitors. This is actually a remake of that section, and this is a new part of the video because something has happened since I made that video. Essentially, I went through 5 of my competitors, because I'm not the only person doing this. I have other competitors in the industry, obviously, and I went through the 5 closest competitors to me, the ones that you would find on Google if you were doing your own due diligence, and I just compared our results head to head. And I felt like I was being extremely complimentary towards them, their websites, their intelligence, their well-written blog articles, their information that they were disseminating, and this is all good stuff. And I felt like I found a pretty good balance of about 90-10, 90% complimentary, maybe 10% criticizing a little bit, that the performance in a lot of cases has been subpar. But a couple of them actually emailed me directly and asked me to remove that part of this video. So, I'm a courteous person. I'm a Canadian. I guess we're polite people. So I'm going to go ahead and do that. I don't mind doing that if they're going to ask me. It's a little bit different than me. This is not how I would have gone about it. I'm a competitive person. For those of you who don't know about me, I used to be a professional golfer. Of course, that was 16 years ago, but I have a competitive spirit in me. So if somebody drew, my website and critiqued it and said that, hey, his results are not as good as mine, my response would not have been to email that person and ask him to remove it from his blog. My response would probably be to hit the books harder, to study more, to figure out what's going wrong with my strategy, to make sure that my results are better than my competitors in the future. That's how I would handle it. But you know what? It is what it is, and I'm going to go ahead and remake this video, this part of the video, question 3, and this is the new one. So, I'm not going to use any names. I'm going to use initials. For people who have done their due diligence, they're still going to know what these initials mean, but I'm going to use initials, and I'm not going to open up any websites like I did in the first video. Basically, I'm just going to use screenshots of their performance only, with every information that leads you to believe that this is that person, all blobbed out. I basically scratched it out. So it's basically initials and screenshots. And this is the best I can do because this question is important. These subscription-based services, we are not fully serviced, financial planners here. We're not talking about estate planning. We're not helping people with their child's retirement or their education funds. We're not helping people, share money with their spouse to avoid taxes. Performance matters. That's all I'm doing here is I'm just answering member questions talking about performance. So this is publicly available information. Our websites, here it is. Here's my website. If you want to use mine, again, go ahead and use it. I've posted everything. I've posted all my results. I've even posted every trade that my strategy has ever taken. So going back all the way to 2010, even dragged back the back test all the way back to the very beginning. This is every trade it would ever have taken. If you want to use my website, go ahead. I won't email you. It's fine. But I do have to do this for those people. So here we go. Here's the new part of the video. Okay, so to keep this a little bit shorter, I'm just going to skip the first 2, and I'm going to go to one called VS. Now, again, of course, I wish I could just say what it was, because he actually did write a very good article on this blog that I wanted to highlight, because there's a lot of misinformation going around. If you read some Seeking Alpha articles or Business Insider, Bloomberg, wherever, there's a lot of people talking about how these products derive their price based on some type of buy high, sell low dynamic going on, and really that's not true. And this guy wrote a very good article explaining why it's not true and all the reasons why they actually derive their price. But I can't highlight any of that anymore, so we're just going to go straight to the results. So there's a couple of strikes here. The first is, of course, a lack of experience. Starting in May of 2015 just isn't enough time. I made my first trade in the VXX back in February of 2010. And back then, I kind of thought it was just easy money. I thought if you thought volatility was going to go up, you buy the VXX. If you think it's going to go down, you short it and you just bounce back between the two. You follow the VIX index and, it's free money. And I was totally wrong, of course, and I lost money and it was financially costly. I had some drawdowns and it took me a few years to realize how complicated these products really are. So it's not really surprising that there was a big drawdown there. Again, he switched strategies, it says that down here, over to something else that drew down even further. This isn't a 72% drawdown, by the way. It's actually only a 59 on a geometric scale. But when you draw down 59%, you need a massive, massive recovery to get back to break even. So this year he says he's up 126. To be honest, I have no idea how he managed that, but it says that on the website. So great year, good job. But geometrically speaking, when you draw down 59%, it takes a lot more than 126 the next year to make your money back. So this is what it would look like on a geometric scale. You start at 10,000, massive hit, not quite there yet, still not to the 9,000. So, still got to keep going. So basically, we're just going to eliminate the website because it just hasn't been going for long enough and the results have not been very good. But obviously check back. I wish I could just open it up and just illustrate how much respect I have for this person and how smart I think he is and how well written his article was. But it is what it is. And there's another one as well called VC. And Mr. VC is another really smart guy with a lot of great information on his site. I actually follow his Twitter feed, and I wish I could just tell you what it was. But same problem. Results started very recently, I think just tail end of last year. And while he did approach 100% at some point this year with his strategy, it has subsequently retreated back down to about 30, I believe. So it's quite a big drawdown, and that's why it wasn't included in the comparisons. But VC is out there as well, and you can check it out. I'm sure people know what VC means if they're doing their due diligence. But now we're going to move on to VMS. Now, this is not just isolated to VMS. This happens basically every website I've talked about, and I will talk about, does the exact same thing. But I'm going to go on a little bit of a rant here. So those of us who trade volatility products, we are obviously aware of a few things that the general population isn't. And one of those things is that the XIV, which is the product that all of us trade, didn't actually launch in the real world as a real live product until November 30th of 2010, which is right there. Now, that does kind of beg the question, why on everybody's website are you seeing air quotes performance going back to 2004? So what they're essentially doing, because the XIV is based on a rolling of the front 2-month futures, and we know the structure and the formula and how it works, and the VIX futures did exist going back to 2004, we can actually accurately recreate the numbers. However, the thing that they're missing is that it's one of those sort of grandfather paradoxes where if you travel back in time and you were to kill your grandfather, then you wouldn't have been born, and a lot of problems would arise because of that. It's sort of the same thing, that if the XIV did exist and you just implanted it back in 2004 and it was available to trade, then all of these numbers would be different. So, some of that hedging money and some of that speculation money that's going into the VIX futures and the VIX options and the S&P 500 options market, some of that money would have been shifted over into the more readily accessible ETF market, and it would have changed all of those prices. So we're actually witnessing that live right now. In the last couple of years, you've noticed that certain people's performance has been dropping off substantially in the last 3 years because volatility is getting to be a very popular thing, and volume is picking up, it's exploding, there's new products being launched, and it's actually changing the underlying structure of the volatility market. That would have happened as well if the XIV existed in 2004. So all of these numbers are wrong, and there's no reason why they should ever be posted on anybody's website. There's a couple of more problems here. Secondly, I believe that it is just a little bit unethical to be taking advantage of the lack of knowledge in the general population, because a lot of people that visit these websites, there's no reason why they would be aware that, when these products launched and on what date. People would look at this and think, wow, he's been trading for 12 years and look at these results. It's unbelievable. So I think that's a little bit unethical to post something that didn't exist. And lastly, as far as compliance goes, there's nothing wrong with backtests. Backtests are totally industry compliant. If they're based on a set of rules and they're systematic in their approach, they're very informative, and we use backtests all the time. They're very useful. However, one of the rules for compliance of a backtest is that a real live person would have to have actually been able to make the trade. So since the product didn't exist in the real world, a backtest before November 30th of 2010 is totally industry non-compliant. Now, there are ways to say that, look, I'm just a subscription-based service. I don't actually have to answer to the SEC. Well, that's true, but, we should at least, ethically speaking, attempt to be compliant with industry standards. And so a backtest for a product that no real live person could ever have actually taken part in is technically non-compliant. So for all of those reasons, you should never see results being posted before November 30th of 2010. Anyway, he did report results past that from 2011 to 2016, so we're going to use that in the comparison section. And the last one that we'll get into is TV here. Now, TV, of course, is doing the same thing as the other ones, using non-ethical, non-compliant, inaccurate numbers for over half of the performance that they report. But again, we're just going to ignore that and use some realistic numbers. But just on a side note, one thing that you will also not find very often on these websites for my main competitors is a chart. So there's nothing wrong with not being mathematically inclined, but when the average person looks at this, and you're watching this video, take a look at this picture and imagine what it looks like. Can you see it in your head? Is it very clear to you what is going on here? Are the returns positive? Are they negative? What's the biggest drawdown? I mean, how consistent has it been? You won't often see charts being posted because charts make it all very easy. So I have a wall of numbers as well. Everybody has to post what they're making every month. And I make it slightly easier by looking at the bottom of the screen, what I made in each of the individual years. But of course, just to make it real easy for everybody, just do this. There's nobody in the world that can't size this up in 1 second and see what's going on. So that's the one thing that bothers me, is that what you'll often be confronted with is stuff like this that, in this case doesn't even really show the yearly numbers. This one at least shows the yearly numbers, but, again, over half of them didn't exist. There was no secret why this is being done, because it pads the results. If you look at everything before the product existed here, these are absurdly high numbers, and they're obviously going to pad the long-term annualized returns of any strategy. So 99, 146, 133. If you ever did find a way to make 146% a year on your money, you'd be richer than Warren Buffett within 20 years. So obviously this is absurd, but the reason that it's being used is because even if you did have a bad year in 2017 or 2018, even 19, 20, 21, the annualized returns that you get to post would still be pretty good. And if you post it in a wall of text where it's not really clear what's going on, it actually might appear like you're still killing it, even though the last few years maybe you haven't been. So let's just get right to the comparisons. Now remember, VS didn't make it, and VC didn't either, because they haven't been trading long enough. So we didn't use those. I used 2013 as a good starting point, just simply because this is when the volume started picking up on these products. And I don't know a single person who trades volatility products who is using the same strategy in 2016 as they were using in 2010 and 2011, even 2012. So it's really not ethical to post a comparison before 2013, because nothing wrong with a back test going back to 2011. But as far as live trading, we've been trading our strategies for a while, but not 7 years, not that long. So we're going to go back to 2013. And again, you can see that annualized returns, there's been no single year that I have been outperformed. This year and this year were kind of close by one of them. I'm up only 0.1% this year on this guy. But of course, in the long run, it's different. Now, I've said many, many times on my website that let's just ignore annualized returns. It's just a headline number that's meant to wow people. And it's absurdly high, to be honest. So if you were to find a way to make 78% a year on your money every single year, put it into a fund value calculator and see how many tens of millions of dollars you're going to have in no time at all. So obviously game theory is going to kick in. The markets have a way of equalizing things out, and you can't make 78% a year indefinitely. You just can't. So what you really want to be doing, and I've been harping on this, I'm sorry if I sound like a broken record, but what you really want to be doing is looking at the Sharpe ratio, because these are sustainable numbers. These do take into account the standard deviation of your month-to-month results. the safer you are, the more conservative you are, the better you are at reducing drawdowns, Sharpe ratios get higher and higher. So you want a high Sharpe ratio. And there's never been a single year where any of my competitors, all 5 of them, have ever had a higher Sharpe ratio than me. So I feel like I am by far the most consistent, conservative, and safest trader out there. And because of that, when the future kind of settles in and these absurdly high annualized return numbers sort of come back down to earth, as they are obviously going to do, you really want to be with the safe strategy, as far as I can tell. And to bring this all back to a golf analogy, because I was a former professional golfer, I won, probably 45 golf tournaments in my life. And, golf tournaments are 4 days long. If you asked me how many times I was leading the golf tournament after a single day, or after even day 2, it's probably 5, 6, maybe. But, by the end of the 4 days, yeah, I'm winning more than anybody else. Trading is kind of the same thing. I get outperformed on a 3-month or a 6-month or an 8-month period all the time. I mean, this is very, very common. But there's never been a competitor of all of the 5 that I compared against that in a 1-year period, in an extended 1-year period, has a Sharpe ratio better than any of mine in any single year. So I think that's kind of the punchline that, I revealed a lot of information here, and I said a lot of things that my competitors may not want me to say, such as none of our annualized returns are going to continue. None of us are going to be making 133% a year forever, or 78% a year forever. So let's just focus on the Sharpe ratio and keep things consistent and avoid the drawdowns. And the other thing, I guess, is they just didn't appreciate the fact that I said it publicly. So I was using public information. I know that these guys get asked the same number of emails about me and my website, and I know they answer them. So I don't understand what the problem is here. But let's save ourselves the carpal tunnel syndrome of having to type out all of these emails and answer all of the questions to all of the members that ask them, and let's just make a video. So that's my video. That's my presentation. Feel free to use anything you want on my website. I'm giving you full permission. I promise you I will not email you and ask you to remove it from your website. Say what you like about me. I'm proud of my results. I think they're very consistent. So that's it. Again, unfortunate that it had to take place this way because I have so much respect for these guys. Volatility trading is so hard and it's so widely misunderstood. And very few people can do it well. And all of these people do it well. Obviously, there's going to be differences in how people do it. That's no different than in anything in business. Some musicians are a little better than others. Some businessmen make a little bit more. Some, whatever. Some doctors are a little bit better. This is normal stuff. So I'm going to leave it there. I'm sorry if it sounded like a rant. The first video was much nicer. This one, maybe not so much. But in the grand scheme of things, it's fairly unimportant. Let's just see how things progress going forward. So thank you everybody for watching. I do apologize again for that external mic issue. I will make sure that that doesn't happen again in the future. But if you haven't already subscribed to the newsletter, you can do that on pretty much any page on the website. Just scroll down. You just put in your name and email address, and then you're going to get all the articles and videos sent to your email. And if you are ready to subscribe, if you haven't already, if you are ready, all of the subscriptions that I offer, I give a free 2-week trial. So you can try these risk-free. Of course, I do recommend the Total Portfolio Solution, and you do save a little bit of money doing that one. But regardless of which one you try, there is a free 2-week trial for all of them. And again, lastly, just please subscribe to my YouTube channel. I throw up all these videos on YouTube. I have a whole new respect for people who have YouTube channels because this really isn't easy. This is one of the first times I've ever actually seen myself on video, and I hate what I look like. I hate what I sound like. It's very difficult to do. So, show me a little bit of love and subscribe to my YouTube channel so I can put out more videos, and hopefully I can get better at this. And maybe next time I won't be so doped up on drugs and slurring my speech. So thank you again for watching, and I will see you in next month's video.